In the good old days, investing in savings accounts or long-term bonds were probably the best thing to do for low risk and steady returns. And letting your savings grow passively via compound interest was the right investment strategy. However, today short-term interest rates are near zero and risk-free assets aren't really risk-free anymore. Long-term government bonds can deliver large real losses if inflation picks up in the future. This means income investors need an active strategy to manage their funds. We believe dividend stocks with long histories of dividend increases year in year out are the best alternative for passive income investors. In this video we will present you the top 10 stocks from the U.S. dividend champions that have been increasing their dividends annually for the last 25 years. This is a necessary condition if you are looking for regular and consistently growing passive income, but we are going to impose additional criteria to identify the best dividend stocks for passive income. First, we added two more filters, at least 3% annual yield and at least an annual increase of 5% in dividend payout. The results were impressive, but one more touch was needed to rank 10 best dividend stocks. We counted the number of bullish hedge fund positions in each stock and used the statistics to identify the best dividend stock for passive income. Most hedge funds don't invest in dividend stocks for their dividend yield. Hedge funds invest in stocks with huge upside potential. Once in a while some of these stocks happen to be high dividend stocks that have been increasing their dividend payouts consistently. By investing in these dividend stocks we not only hope to capture increasing annual dividend payments but also large capital gains. Having said that, now let's have a closer look to 10 best dividend stocks for passive income. 10 Cullen/Frost Bankers Incorporated, NYSE, CFR. The list starts with a financial holding company headquartered in San Antonio. Cullen/Frost Bankers has managed to enter our best dividend stocks for passive income list despite its relatively small market cap. As of this year's third quarter report, CFR had $40.1 billion in assets, which makes it one of the 50 largest banks in the United States. CFR provides a wide range of banking, investments and insurance services to businesses and individuals across Texas and has a presence in the market since 1868. CFR shares currently trade for $83.16 and have a trailing PE of 15.6. Current dividend yield is 3.42% and CFR's board last month approved to increase its quarterly dividend to 72 cents from 71 cents. We believe CFR's board is a bit cautious right now because of the coronavirus pandemic. In 2019 the board increased the quarterly dividend from 67 cents to 71 cents. We believe the growth rate in quarterly dividend will pick up again in 2021. Although financial results of the first 9 months of 2020 are worse than the 2019 figures, the CEO of the company Phil Green states that, maintaining the philosophy and culture along with the sustainable, organic growth is a positive development in this unusual environment. There were a total of 19 big hedge funds with bullish CFR positions at the end of September. The number of bullish hedge funds in CFR was only 13 at the end of June. 9 Cincinnati Financial, NASDAQ Synth. The stock at the 9th spot in our list is also from the financial sector and it is Cincinnati Financial, CINF. But it is in the insurance branch, rather than banking. And the other similarity is the number of hedge funds that picked this stock in the third quarter, which is also 19. Cincinnati Financial had a $60.57 book value per share on September 30, 2020 and currently trade for $77.40. Based on this figure CINF's trailing PE ratio is 16. The stock pays a quarterly dividend of 60 cents, increased from 56 cents earlier this year, and yields 3.10%. Although income statement figures for the 3 months ended in September are promising, 9 months figure are still in the negative territory. Company's chairman, president and CEO Stephen J. Johnston commented, along with multiple hurricanes and wildfires, brought considerable losses to our policyholders. Confident in our balance sheet and risk management decisions, we were able to focus on what was important, outstanding claims service. Catastrophe events in the third quarter nearly tripled our 10-year average of 6.2 points. Elevated catastrophe losses alone explain the decrease in non-GAAP operating income at Black Hills Corporation, NYSE, BKH. The Black Hills Corporation conducts operations in the electric gas utilities, power generation and mining segments. Among these operations, the first two segments accounted for more than 90% of total revenues. The company was founded in 1883 and has increased its dividends for 50 consecutive years. I think that's really remarkable. The company's current quarterly dividend payment is $0.565, corresponding to an annualized dividend yield of 3.65%. The company increased its quarterly dividend by 5.61% earlier this year. There were a total of 22 hedge funds with bullish positions in this stock. Billionaire Jim Simon's quant hedge fund Renaissance Technologies had the biggest position in BKH among the 800-plus hedge funds tracked by Insider Monkey. BKH is also favored by other quant hedge funds like the Shaw and Two Sigma. Both funds are among the top 10 hedge fund holders of BKH's stock. 7 Leggett & Platt Incorporated, NYSE, Leg. This company also has deep roots. The Leggett & Platt Incorporated was founded in 1883 to produce bedspring with the goal of offering the best sleep yet available. After a little bit of search, I realized that the modern growth era for the company goes back to 1960s. Due to a strategy change, the company has assumed a leading role in manufacturing, marketing, and distribution capabilities on the consumer discretionary sector. As of this year's third quarter, Leggett & Platt had $4,663.8 million in total assets. When it comes to liabilities, short-term debt comprises 20% of total assets, while long-term debt covers the 52% of it. As a result, total equity with 28% share makes the financing side look balanced. Current dividend for the company is 40 cents and in annualized terms that corresponds to a 3.68% dividend yield. Dividend amount has increased 5.26% compared to the previous period. There were 26 hedge fund managers who found this stock worth investing. Among these 26 hedge funds, Scopus Asset Management has a distant leading position. 6 Essex Property Trust, NYSE, ESS. Essex operates in the real estate sector. The company has been increasing its dividend payments annually for the last 26 years. Essex is a real estate investment trust, REIT, that acquires, develops, redevelops and manages multifamily apartment communities in supply-constrained markets. On 20th of November 2020, the share price was $254.10 and PE ratio and trailing 12-month basis was 27.83. From the latest financial reports, I found out that the company repurchased 121,260 shares of common stock totaling $26.6 million at an average price of $219.24 per share, in line with the stock buyback program. Current dividend for the company is $2.08 and in annualized terms that corresponds to a 3.27% dividend yield. Compared to the previous period, quarterly dividend payment increased 6.54%. There were a total of 28 hedge funds with bullish ESS positions at the end of September. 5. Cisco Corporation, NYSE. Cisco is the global leader in selling, marketing and distribution of food products to restaurants, healthcare and educational facilities, lodging establishments and other customers who prepares meals away from home. As it is expected, due to COVID-19 the company's sales and revenues took a dive. In the financial statements following note takes place, the COVID-19 pandemic is more widespread and longer in duration than historical disasters impacting our business, and it is possible that actual uncollectible amounts will differ, and additional charges may be required. When this problem addressed, I do expect a recovery. Now that we have 3 different vaccine candidates showing at least 70% efficacy, it is time to get back in recovery stocks like Cisco. The company has a 2.57% dividend yield and it increased its dividend from 39 cents to 45 cents last year. The company may not be able to increase its dividend at the same rate next year, but analysts are optimistic about 2022. When it comes to the number of hedge funds, There are 33 managers who were invested in this stock at the end of September. 4. General Dynamics, NYSE, GD, at the fourth place is a company from the aerospace and defense industry. Although COVID-19 had adverse effects on this industry, the company managed to limit the damage. Company's chairman and CEO, Fabian Novakovic, stated that, "We continue to reduce debt and invest in the company for future growth." Oakmark Funds is bullish about GD. GD shares currently trade at $148.36 and have a trailing PE of 13.5. This figure is also the lowest in our list. The stock's current quarterly dividend is $1.10, corresponding to an annualized dividend yield of nearly 3%. Compared to the previous period, dividend payout was bumped up by 7.8%. There were a total of 37 hedge funds with long positions in the stock at the end of September. 3. Chevron Corporation, NYSE, CVX. Chevron is one of the world's leading integrated energy companies. Its main operations focus on explore for, produce and transport crude oil and natural gas, refine, market and distribute transportation fuels and lubricants, manufacture and sell petrochemicals and additives, and develop and deploy technologies that enhance business value. Without a doubt, lockdowns and slumping demand due to COVID-19 had drastic effects on the company's sales, but still 43 big hedge funds took bullish positions in this company. The best time to invest in oil stocks was 3 weeks ago, before the announcement of vaccine news. However, we aren't too late. Chevron shares increased about 40%. But there is still room for an additional 20% increase over the next 12 months. While you wait, you will receive quarterly dividend payments of $1.29, corresponding to a 6% annualized dividend yield. Chevron managed to increase its dividends for 33 consecutive years. If we look closer to top 3 funds that have strong positions at Chevron, we see Fisher Asset Management at the first spot. Billionaire Ken Fisher is one of the most well-known money managers in the financial world and had around $390 million worth of position in CVX. Kahn Brothers and Diamond Hill Capital also have large positions in the stock. 2. ExxonMobil Corporation, NYSE, ZM. Similar to the Chevron, ExxonMobil also operates in the oil, gas and consumable fuels industry. Over the 135 years of its history, Exxon evolved from a regional marketer of kerosene in the U.S. to one of the largest publicly traded energy companies in the world. There were a total of 52 hedge funds with bullish positions in them at the end of September. Almost with $1 billion sum, First Eagle Investment Management has the largest position in the stock. Here is what they said in their Q3 investor letter about the stock. The stock of ExxonMobil continued to struggle in the third quarter, and it lost roughly half its market cap year to date. Despite this, we believed ExxonMobil was well equipped to contend with lower prices and remained a compelling investment. The company demonstrated high levels of operational flexibility during the difficult market environment and maintained an upward drift in earnings power. Its high-quality, long-duration assets occupy attractive positions on the cost curve. Indeed, the large decline in shares resulted in a double-digit dividend yield earlier this year. ExxonMobil has successfully increased its dividend for 37 consecutive years. Current dividend for the third quarter of this year is 87 cents per share, and that makes a 9.42% dividend yield in annualized terms. This number is the highest yield offered by the companies featured in this article. We agree with First Eagle. Exxon shares offer a large upside over the next 12 months. 1. PepsiCo Incorporated, Nasdaq, PEP. In 1965, Pepsi-Cola and Frito-Lay merged to deliver their products under a single company. Their products are enjoyed by consumers in more than 200 countries and territories around the globe. Did you know that PepsiCo spun off Kentucky Fried Chicken, Taco Bell and Pizza Hut in 1997? During the first 9 months of 2020, PepsiCo generated almost $48 billion in revenues, $5.28 billion in net income, and $3.79 net income per share. From the recent financials, the following statement was interesting. Additionally, our industry continues to be affected by disruption of the retail landscape, including the rapid growth in sales through e-commerce websites and mobile commerce applications, including through subscription services, the integration of physical and digital operations among retailers, and the international expansion of hard discounters. We have seen and expect to continue to see a further shift to e-commerce, online to offline, and other online purchasing by consumers as a result of the COVID-19 pandemic. This explains the strong revenues and cash flow in spite of the difficult conditions that we face. On 20th of November 2020, the share price was $143.42. At the end of the third quarter there were 52 big hedge funds positioned in this stock. Among these asset managers, Donald Yachtman's Yachtman Asset Management sits at the top spot. Pepsi is also a favorite of several quant hedge funds like AQR Capital Management. Current dividend for the company is $1.02, and in annualized terms that corresponds to a 2.85% dividend yield. Compared to the previous period, dividend payout was increased by 7.07%, from $0.9550 to $1.0225. PepsiCo Incorporated increased its dividends for 48 consecutive years.